This is the One Point podcast, and I'm Rohit Yadav. Welcome to this new streamlined format that is shorter, sharper, and more impactful. In each edition, I'll spotlight either an insightful trend from the ecosystem, or a thought provoking perspective from a venture expert, or a bold idea worth exploring further. And today I have John Rikhtegar with me, whose post on venture alignment and IPO dynamics made quite some noise for me to invite him today on the podcast. So, John is Director of Capital Investments at RBCx, where he's leading their direct and venture capital fund investment strategy, as well as creating new equity and debt linked products, which are tailored to the VC industry and producing RBCx data driven thought leadership on the VC industry. He also held various roles in corporate development, revenue operations, as well as go to market at select growth stage technology startups and companies in both Canada and United Kingdom. With that, John, welcome to the podcast.
Rohit, thanks for having me. Looking forward to this one.
So let's dive right into it. So first of all, briefly explain what is RBCx?
Yeah, absolutely. Our technology and innovation banking arm. So essentially what we're responsible for doing is supporting Canada's innovation ecosystem by commercial banking the portfolio companies that VC funds invest in, supporting the VC funds themselves through both debt and equity products, and then essentially building almost like a Rolodex of strategy consultants and experts that can help get deployed into our growth stage banking clients to help them scale a lot more hands-on so that we're not just viewed as a bank, but we're viewed as actually a strategic extension to a lot of our clients. Think of us as all we do is tech, we live and breathe tech, and purely focused on supporting Canada's innovation economy.
Okay, so it's just focused on Canada, right?
At the moment, just focused on Canada, but I think this business definitely has global ambitions, but Canada is an awesome place to start.
Okay, awesome. So the most important part of the discussion, your two posts that we're going to discuss today. So the first one, which is focused on small versus bigger funds, you mentioned why smaller VC funds often produce the strongest GP-LP alignment. And you argue that it's not about the outperformance, but also about the economics. And it was a very nice post, right? It became very famous within the ecosystem. So if you can expand on that and kind of clarify what were the top highlights.
Yeah. Absolutely. And I think there's a lot to unpack here. So let me first off by just setting some context. I think everyone in venture would probably have heard the term kind of small funds outperform. And the reason why that's the case point blank is just because it's a lot easier to 3x a small $50 million fund than it is to 3x a larger $500 million fund. And the example that I'll make, like, let's say, for example, if you assume two different GPs, you have a $50 million fund and one that's a $500 million fund, and say both of them generated $3 billion in aggregate exit value from their portfolios. Now, assume the $50 million fund probably owned 5% of their portfolio companies on exit, and then say the $500 million fund owned 15% of their portfolio companies on exit. Essentially, what would have happened is the $50 million fund would have produced $150 million in exit proceeds to the fund. So that's $3 billion times their 5%. But the $500 million fund would have produced only $450 million in exit proceeds, $3 billion times 15, to their fund, which wouldn't even have returned the fund one times over. And so that's exactly why people say small funds outperform. Now, if you go a step deeper and we talk about the management fee base, this is where it actually gets really interesting, right? So the $50 million fund, if you just assume a 10-year standard 2% management fee base, 2% over 10 years on a $50 million fund, that's $1 million a year or $10 million over 10 years. If you do the same math for a $500 million fund, it's 2% for 10 years on a $500 million fund, that's $10 million a year. It's $100 million over 10 years. That means that the $500 million fund would have actually generated 10x the management fees than the $50 million fund, which is completely guaranteed irrespective of performance. And Rohit, I think that's like one of the most important pieces here is it's irrespective of performance. And so even though we just went through the example where the $500 million fund didn't even return 1x from producing $3 billion of aggregate exit value, they would have generated $100 million in fees, whereas the $50 million fund would have generated their $10 million in fees over a 10-year period and $20 million in carry from producing that 3x gross, which would actually only be a third of the $100 million. And they produced a 3x, which is over 3 times better than what the $500 million fund did. And so lastly, if you think about it from an LP perspective, the LPs in the $500 million fund wouldn't have even made their initial commitment back. Whereas LPs in the $50 million fund would have generated a 2.6x net. right? They would have gotten their $50 million back. And then on $150 million of exit value, $100 million of carry, 20% of that is $20 million, 130 over $50 million, which is the 2.6x net. So that's the whole sequence and math and the incentives. That's really crazy to me. So the crux of this post that I kind of put together a few weeks ago, yes, small funds outperform, and small funds outperform really based on the simplistic way of thinking that it's a much easier to 3x a $50 million fund than it is to 3x a $500 million fund when you assume fair, company quality and relative exit ownership percentages. But the real strength in small funds comes from the fact that GPs are not able to get rich simply off guaranteed fees. More importantly, the second piece, which is the wealth creation path for both GPs and LPs, are both completely aligned to the variable portion of the equation, which is in carried interest. So what I spoke about and what the graphic kind of showed for those who didn't see it, it was pretty simple. It was essentially two charts that were stacked on top of one another and 6 bar charts on each chart. And the bar charts essentially were 6 different funds. And the 2 data points that I had on each one of those funds was how big's the fund and how many partners are at the fund. And these are actually real life examples of funds that were raised over the course of the past 3 years. Okay. What I wanted to see on the top chart was essentially what's the net TVPI required at a fund level for each of the partners at the fund to generate $50 million in total compensation. And so on one hand, you had a $1.2 billion fund that had 8 partners. And on the complete other end of the spectrum, you had a $15 million fund, which was a solo GP fund, so one partner. Now, for each partner to generate $50 million in total compensation, assuming all partners have the same kind of carry ownership and management fee split, on the $1.2 billion fund with 8 partners, all they would need is a 1.5x net TVPI for each of those partners to generate a $50 million total compensation after 10 years. If you go to the other side and you look at the $15 million solo GP, they would have needed to produce a 13.5x net TVPI, 9 times higher, which is pretty remarkable. And then the chart at the bottom, which I wanted to double click on, was I wanted to say, okay, of the $50 million of compensation, how's that broken out between what's actually variable in the form of carried interest and what's guaranteed through management fees? And on the $1.2 billion fund with 8 partners, $30 million or 60% of the $50 million is guaranteed through fees and only $20 million is through carry. Whereas in the smaller fund, only $3 million is through management fees and $47 million is through carried interest. So it was that kind of anecdote where, yes, again, small funds outperform, but for me, the specialty in small funds also is equally as important as the actual alignment piece, which I don't think maybe gets spoken about as much.
Got it. I mean, you mentioned quite a lot of math behind it, and probably that's not the right place for us to kind of counter argue and go in the details. So I would leave it to the listeners to do that, and we'll provide the link over there. But I want to connect now the performance, the alignment together. So do you believe the strong alignment directly correlates with long-term success? And what I mean by that is specifically for small emerging managers, which are quite a lot in numbers right now as compared to the established ones, right? And there are more and more coming up every single year and every single quarter. Do you think realistically they are more likely to succeed just because they are more aligned compared to established funds when you compare on basis of returns?
Yeah, so I think this is a great question. So what I'll first say is if you're going into a 10-year partnership with misaligned incentives out of the gate, I think that's a recipe to have a pretty good amount of risk that doesn't need to be there. So that's what I'll say off the hop with kind of some of these significantly larger funds. But what I'll also say, Rohit, to your point is, having strong alignment in and of itself is not enough to guarantee long-term outperformance in venture capital. And the reason why small funds, if you look at kind of a basket of small funds and a basket of large funds, for those who understand the asset class, like the dispersion of returns is obviously going to be a lot wider for the smaller fund set versus the dispersion of returns will probably be a lot tighter for the larger fund set, just purely based on kind of fund math and how power law underpins the entire asset class. Let me explain to you though, because I think it's probably helpful, why small early stage funds is where I'm spending a lot of my time today. And it really comes down to 2 points, 2 factors, I guess, that are happening in the market today. The first is companies are staying private longer. And as a result, the second thing is illiquidity premiums relative to the public markets or other asset classes are actually shrinking. And so let me even take a step back there and unpack that. As an LP, one of the things that we talk about a lot, whether it's with existing managers or prospective managers at some point, is kind of performance expectations. And a lot of the time when I speak with early stage pre-seed or seed funds, the answer to that question is very similar. And it's kind of in 2 parts. One is folks say that they strive to be a top quartile performing fund. And the second is, we strive to, produce 3x over a 10-year period. And one of the things I wanted to do, because I heard that so often, was actually pressure test how realistic is that happening? How realistic is it to be a top quartile performing fund that actually can produce a 3x net over a 10-year period? And so what I looked at is I looked at Cambridge Associates data. And I specifically looked at Cambridge Associates data from 2000 to 2015, The reason why I chose those years is because I like to think the majority of the value in those funds is probably realized or crystallized in the form of distributions, and the majority of those funds are at latest in their harvesting period. And what I found was when I looked at top quartile DPI across those 15 vintage years, only 1 year of the 15 was the top quartile DPI mark above a 3x. And it was actually in 2010 where the top quartile DPI mark was 3x. So the first point I'll tell you is when you get pitched top quartile and 3x in the same sentence, that has almost never happened. But what I then wanted to kind of understand is I said, okay, well, if you're not getting a 3x in the top quartile mark, how high up do you have to go to get consistent 3x net returns? And it's only when you go into the top 5% of funds in any one given vintage year. So from 2000 to 2015 vintage years, top 5% of funds by DPI, do you consistently get 3x to 5x net DPI funds? And this is really important because, if you think about GPs previously targeting 3x net in 10 years, and in reality, given companies are staying private longer, given the path to going public or even the appetite to go public isn't necessarily as there anymore, 10-year terms are kind of turning into more realistically 15-year terms. And for those who, again, understand this piece of the equation, if you keep your multiple the same, but your time gets dragged out, the reality is your IRRs come down. And as your IRRs come down, the illiquidity premium relative to venture to either mid-market private equity or even public asset classes where there's a lot less risk and are fully liquid isn't necessarily as strong. And so that's why, from my perspective, when I think about venture today, and I'll bring this back to the point you mentioned on, do you think alignment is important enough for outperformance? I don't necessarily think that top quartile is actually good enough anymore for early stage venture capital, which could be a bit of a top hot take. And with companies staying private longer and fund terms getting extended quite substantially, I think the target needs to be being in the top 5% of funds for any one given vintage year to really justify your existence. And if you think about the top 5%, Rohit, that's 1 in every 20 funds. Now, the last thing I'll say on this is when you bring it back to your original question, what type of funds are able to achieve X net type returns? It's probably not these multi-billion-dollar mega funds. It's small, early stage, high initial ownership relative to their fund size type funds where the GP and LP alignment is the tightest, as we kind of spoke through in the previous question.
Okay. So there are a lot of things to unpack over here. Let's start from the bottom one, right? So the last one, sorry. The industry as an overall, whether it's expecting 3x or not, same as the smaller funds versus established funds, is a question in itself, right? So now there is a bigger discussion. I also come from an LP background, and in some cases, because of dispersion, because of all the topics we talked right now, maybe those LPs are not really looking for 3x performance for those bigger funds. Maybe they're underwriting a different return level altogether, with which actually they are comfortable given how the returns are shrinking in all the other asset classes. Talk about private equity, talk about private credit. All the asset classes, is private ones, they have a shrinking kind of return target levels, right? So not going over there and saying whether the 3x is relevant and how relevant is for each LP, because it's a very different ballgame altogether. But what I hear from you specifically on this topic is the alignment itself is not important, right? I mean, you kind of underline this fact that even if you have a strong alignment which exists for all the smaller emerging managers, it doesn't guarantee success. And if we just talk about this emerging manager ecosystem where the X is more likely to happen, as you described the maths right now, it's more likely that only the top 5%, 1 in 20 fund would reach there, top tier performance and 3x. And so more than alignment is about selection, right? So we can talk about the alignment through the fees for emerging managers, but a smart LP would rather say, hey, you know what? I want alignment, but I also want to select the right GPs. So that's kind of the overall equation, right?
For sure. And I think, you raise a few points, which I totally agree with. I mean, I think the LPs that are investing in multi-billion-dollar mega funds aren't necessarily looking for that 5x net return. They're probably looking for, how do I actually get multiple turns or one turn of a much larger capital base so the absolute dollar return is a lot larger versus if I were putting smaller tickets in much smaller emerging manager funds. I think the job of a VC is at the end of the day to generate a really strong financial return. I don't think alignment necessarily is a direct correlation to a much stronger financial return per se. But I think what you bring up are really important and fair points.
Okay. So, John, I mean, there's a connected question to it, what we all discussed right now. Where does fees actually stack up in the whole manager evaluation framework. So first you go ahead, explain, you're an LP, you select the funds, that's your job. Where does fees actually rank in your evaluation process?
I mean, listen, it's part of a mosaic. So, at least from our perspective, when we're underwriting a fund, there's a multitude of different things that we look at. The way that I think about fees, more broadly speaking, even zooming out first, is economic alignment of interests, and that's predominantly before the general partners and the team at the fund. So, what kind of questions do we ask when we think about economic alignment of interests specifically? We'll look at what type of salaries the GPs plan to take, what type of outside compensation, if any, do they receive monthly? How's the GP commit broken down across team members, and in aggregate, how much is the GP commit? And then how is the GP's 20% portion of the carried interest actually broken down across team members? And then I think one of the interesting things that you can also do is you can look at, what type of net return is actually required to be able to produce a multiple of what's guaranteed through management fees in the form of variable or carried interest compensation. So in that same $50 million example that we kind of went through at the beginning, if you assume two partners there, a 2x gross turns into a 1.8x net. That would mean each partner would get roughly $5 million in fees and $5 million in carry. So it's roughly a 1-to-1 ratio. But if you get a 5x gross and a 4.2x net, you still get that $5 million in fee for each partner, but they now each get $20 million in carry. The delta between a 4.2x net and a 1.8x net, if you divide the two, is only 2.3x. But the multiple of carried interest compensation goes from $5 million for a 1.8x net to $20 million for a 4.2x net, 4 times the ratio. So understanding how multiple turns of the fund can highly influence the variable portion of the compensation versus the guaranteed portion, I think is part of the underwriting that we look at when we look at economic alignment incentives.
Okay. So within this economics of a fund, within this alignment bucket, you mentioned quite a lot of points that you check. And actually, I agree to all of them very important. But within a manager evaluation framework, wouldn't you keep the strategy of the fund, how they have performed before, or other aspects of the fund, team in itself, not economics of the team, but team in itself, for example, higher than this economics part of the fund? This is what I'm actually trying to get at. So like
Absolutely.
what's the level? Like, do you check the strategy first, then you go to, for example, team, whether the team is capable of delivering on the strategy, what has been their past experience or running the fund, whether it's fund 1, 2, and 3, and so on. And finally, if all of that kind of makes sense, probably then comes this topic of, oh, does the fees make sense? Are these all the partners getting compensated enough, and so on? So that's never the first question, but rather somewhere in the middle. That's what I'm trying to get at.
Yeah, sorry. That's a great question. So you're absolutely right. We don't lead with fees and don't kind of let that be some of the main reasons as to why we make decisions when it comes to from an investment perspective. Listen, again, taking a step back, if you think about venture capital and investing in venture funds, you're investing in a blind pool of assets, typically. And so what that means is you have no idea what the companies will be, what businesses they'll be building in, what the founders will look like, what their backgrounds will be. All you really know are the partners at the firm. And so what you're fundamentally underwriting is do you think the partners at the firm are able to execute the strategy that they say they're going to execute on? Do you think that strategy is compelling? And most importantly, do you actually want to be in business with those people for 10 plus years? So from our perspective, I think the biggest weighting we put is the team, and that's first and foremost. But Rohit, to your point, everything from going incredibly deep on fund strategy to portfolio construction to track record to fundraising and terms to kind of GP market fit, all of that kind of comes together in that mosaic that I was talking about.
Yeah, true. Makes sense. Last question on this specific point is, have you seen a deal fell apart just because of the fees in this venture business?
So I've not. And, I've only been doing this for 4 years. So I'd like to consider myself relatively new. The unique part about the Canadian ecosystem is we don't have as prominent of a mega fund cohort as in the US market. And the majority of the funds, if not all the funds in the US market, are kind of typically 2 and 20. So I've not seen a fund or an LP kind of pull out because of fees not being lowered.
I mean, the way I think about it is, and maybe you can correct me if you have a different understanding of it, is if you are within that channel of fees, let's say 1.75 to 2.25, somewhere in that range, fees is never the first question that probably I would ask or I would think about, because you're within that kind of space. And the second point I would look at is, has it increased tremendously against their fund 1 or the last one? If, for example, they were charging 1.75 and now they are charging 2.5, there should be an explanation to it. So if you're in the same channel, everything is good, at least for the first go. And then obviously we discuss within the due diligence process. but it's never then the first question. But the more important part, which actually nobody is talking about, and maybe you can cover in your analysis because you have access to all the funds, is that post-investment phase, what happens to that? And there are so many funds which are charging the same amount of fees over and over every single year post the investment phase as well. And the bigger question is, are they adding any value? So if you compare this to private equity, for example, a private equity asset, you have an investment phase of 3 years. The asset comes into the portfolio. Private equity, because of the way it functions, the GP have to put a lot of effort. Maybe it's through financial changes, maybe it's through operational improvement, cost, revenue, and so on. So there is a lot of effort from the GP itself to improve the portfolio company. But it's not the same within the venture ecosystem. And there are a lot of, for example, GPs who are actually not doing it. So the post-investment phase fees actually should gather more attention. That's what I feel. And maybe you have a couple of words on it.
Yeah, no, I think it's an interesting point. One of the things, so I think venture capital, I think what a lot of people are starting to realize is there's pieces of the private equity playbook that need to be adopted in the venture market. One of which potentially is this kind of fee piece you're talking about. A lot of the managers that we support, some do have a fee base based on aggregate committed capital over the 10-year period. That's just flat and standard. Some have a fee base based on aggregate committed capital in the first 5 years and then net invested capital in the latter 5 years. And then some actually split it out in terms of a third based on investing, supporting, and harvesting. And the fee base would actually kind of trickle down as the fund term winds down. So I'd like to think that there aren't many funds that we are supporting that have that kind of aggregate fee base. But again, I think what it comes down to is it's probably a balance between making sure the firm is able to operate accordingly and execute on their strategy and have the appropriately sized fee base to do so. You don't want the fee base to be too thin, but you want it to just make sure that it isn't kind of out of line. That's taking away from some of the incentive pieces that we spoke about earlier.
Awesome. So let's wrap it up. Let's wrap this section because we have your amazing posts, which everyone can look at the math, look at the discussion, and listen to a discussion what we did today, right now, and then move to the second very important post, which you recently published as well, is on the IPOs. And your analysis was around the power law. And you did an analysis of around 414, if I'm not wrong, North American VC-backed IPOs. So these are not general IPOs. These are VC-backed company IPOs from 2010 to 2022. And you showed how the power law exists within the public markets itself. So a lot of people talk about power law in private markets, specifically when we talk about venture, but they don't understand when that firm goes into the public markets. And you kind of clarified that for us. So please explain the biggest takeaways from your post.
Yeah, thanks, Rohit. This one was a lot of fun. And again, let me set some context for folks who haven't seen it. So as Rohit mentioned, venture capital is underpinned by the power law. It's that attribute that very few funds and very few companies are responsible for making up the lion's share of the asset class's returns. And when you look at the dispersion of returns in venture capital and you compare it to other private asset strategies, whether you're looking at real estate or private equity or secondaries or fund of funds, the return dispersion is so wide. And it's so wide because there are only so few companies that make up the lion's share of the returns. I think you actually had David Clark on your podcast, and he's infamous for kind of speaking to the companies of consequence in any one given vintage year that really matters. And so that's why he invests in a lot of the blue chip names, and because they're able to access these amazing companies. What I really wanted to understand was, is this power law dynamic fundamentally unique to private VC-backed companies in the private markets? Or when these VC-backed companies ultimately graduate to the public arena, does it actually follow with them there? And the biggest insight I found after going through this analysis was the exact same power law and principle that exists in the private markets for VC-backed companies actually exists for the cohort of VC-backed public companies as well. So when you break out, and you're right, it was 414, but when you break out the 400-ish or 414 North American VC-backed IPOs that happened between 2010 and 2022, with at least 3 years of trading data, the top decile of returns at the 3-year mark had a cumulative return of over 400%. Pretty phenomenal. But 70%, or the bottom 70%, so the bottom 7 deciles, after 3 years of going public, traded below their initial IPO valuation. And what's even crazier is the median return for that 414 cohort of North American VC-backed IPO companies from 2010 to 2022, after 3 years, was actually down 57% from their initial IPO valuation, which is pretty crazy. And so this analysis really made me realize that it's almost as though when you see early stage GPs speak about the fact that in our portfolio, the majority of the companies will be written off if fuel return costs, and the majority of the fund multiples will come from a very small subset of companies, i.e., the power law. It's almost as though that power law exists in the private markets. And then when those companies graduate to the public markets, it almost resets. And now there's a new resetting of the public market, of the power law, which happens in the public markets, which is what some of the insights and some of the data that I shared with on LinkedIn last week.
Okay. So just to understand it better, you talk about companies ending up in the top decile 3 years post IPO often show signs of outperformance within the 6 months of a year to a year, right? So whatever companies land in the top decile that you mentioned of exceptional performance, they show this kind of outperformance very early on. So what are the characteristics of those early signs of these winners?
Yeah, that's a good question. I mean, I don't necessarily know. So, well, what I'll tell you is I haven't done that analysis quite yet. So what do
Okay.
they really look and feel like? What do they really look and feel like? But I think that's something I definitely will do because the data shows that there's correlation to 1 year performance and 3 year performance. But let me kind of answer your question in a different way. The reason why I wanted to look at 6 months and 1 year were for two specific reasons. At the 6 month mark, as you well know, Rohit, that's when a lot of the private company shareholders, venture investors are kind of past their lockup period as to when they can actually sell their public company, typically. And that's a very important nuance of going public because a lot of investors and a lot of the commentary from a market perspective treat IPOs as pure play liquidity events. And I think that's actually kind of dangerous because I actually view them not as pure play liquidity events, but financing events towards a potential liquidity event down the road and the ability to use a public currency in the public markets to kind of continue to build as a public company. I mean, if you look at Figma, Figma is obviously the newest kind of cohort, I think, to the 2025 kind of VC-backed IPO cohort. After day one, they had a market cap of 68 billion. I think I looked at it this morning and it was at 26 billion. So, and it's been a month, and that's a pretty significant decline. So there's a lot of funds that obviously are going to make a good amount of capital for their LPs based on that investment in and of itself. But the market capitalization of Figma in terms of the price in which they actually liquidate their shares at after 6 months of the company being public and the IPO valuation at day one could be very similar, but also could look very different. So I think that's just one nuance. But what's interesting to your point, Rohit, is when you look at the 1 year performance, so you look at what the IPO cohort are trading after 1 year, all the deciles of the data set have actually settled into their deciles fully, meaning there isn't any changes from where the companies are trading at after year one and where the companies then trade at after year three. And so what's interesting is when you think about the public market power law, the insight is it's definitely real and that there's very few companies that graduate to the public markets that were previously venture backed that are responsible for the lion's share returns. But more equally importantly, and probably unique to the public power law, which is different than the private power law, is the dispersion of returns starts to show a lot quicker. And so you start to see that when you look at the return dispersion after 1 year, which ultimately has a correlation to how these companies perform after 3 years.
Okay. So how should investors understand on when to exit? I mean, that becomes like a very important question, right? So some investors try to hold afterwards as well, like after the IPO, they keep on holding to some extent. Some investors actually join pre-IPO. So there's a lot of kind of pre-IPO secondary trading as well without understanding, hey, you know what, if the IPO happened at 68 at the market cap and now it's 26, for example, it's actually a huge downgrade and maybe it's better to take entry in the public markets rather than PIPO. So how do you kind of evaluate is the bigger question, and whether there's some kind of basis or understanding towards um, what's the best time to access these private to public markets conversion.
Yeah, you're asking some of the $1 million questions. I wish I wish I had a clear-cut answer for you. I'd say every situation is different. Every investor has their own philosophy when it comes to graduating companies to the public markets. How much, if they can sell into the IPO, how much they plan to hold post-public, how much they plan to liquidate after they're locked up or after the lockup's expired. So I wouldn't necessarily say that there's a one-cut answer into what makes sense. What I'll tell you is, when you think about the impact of market cycles, one of the pieces that I very briefly touched on in this in this post, but didn't really go into a lot of details on, is the actual cohort concentration of each decile by vintage year. And let me, that's a bit of a jargon word, but let me kind of back that up for a second. We all know the market was crazy in 2020 and 2022 from a valuation perspective, both in public and private markets. And so what's interesting is of the 414 companies that are part of this analysis, about 165 or 40% of the data set came from IPOs between 2020 and 2022. And, what I wanted to understand from that point is where those companies actually were most concentrated after 3 years in their deciles. And what's really interesting is, for those that exited to the public markets in 2020 and 2022, 3 years later, over 55% of those IPOs were trading in the bottom three deciles,
Okay.
down, which means that they were in aggregate down 82% from their initial IPO valuation. And another way to look at this is if you actually flip it, if 55% were in the bottom three deciles, down 82% after 3 years of trading, for that 165 IPO cohort that happened between 2020 and 2022, only 4% of that cohort was in the trading in the top three deciles. And that's why the importance of market cycles is really important. When you think about, I can't tell you when the right time to sell is, but what I can tell you is when you look around and start to understand how the market's reacting and how valuations are being priced and kind of overall sentiment from a public perspective, there definitely is things that with hindsight you can see are happening that potentially are signs of risk or signs of frothiness. What's also interesting though, Rohit, is if you look at, the main vintage years that made up the top three deciles after 3 years of trading, what was also interesting in the emphasis of market cycles is probably unsurprisingly to most, 2016, 2017, and 2018 had the highest concentration of companies that IPO'd in those years in the top three deciles after 3 years of trading. And that was really a byproduct of the fact that the companies, whether they knew that this crazy bull market was happening or not, were able to enter the private markets a few years ahead of when the market ultimately peaked, such that at that 3 year mark, they were trading at a pretty significant premium. And a lot of the investors that were in those companies, whether they were locked up for 6 months or a year, or were able to kind of get liquid after that, obviously made a pretty significant penny. So I think public markets, they're really based on forward-looking expectations for a company. And that's the general view that public market investors take. But I think there's definitely value in looking at market cycles and macro factors when it comes to understanding when you should sell, how much you should sell, and how do you balance kind of managing your position ultimately for your LPs to generate the best return.
Yeah, so it's a combination of fundamentals and timing, which actually nobody knows when it's the right time. It's always in the hindsight, it's much more clearer, right? Whether it was the right timing or not.
For sure. And in venture, I'm sure folks on this podcast that you've had on have spoken about this, but that's why it's impossible to time venture capital. Why you need to have consistent capital allocation across these few vintage years, because that's probably one of the most important pieces when it comes to generating strong returns and a strong portfolio that can withstand these market cycles.
So, John, when we talk about IPOs, liquidity is connected topic, right? So IPOs is one channel through which liquidity is achieved for the venture markets. So what's your perspective on the overall liquidity markets in 2025 and maybe 1 year down the line in 2026?
Yeah, good question. So, the unique thing, and I'm stealing this from Bill Gurley, but it's really resonated with me for the past few years. Venture capital, from a market cycle perspective, it's less like a sine curve and more like a sawtooth wave. You have a gradual risk on investing period, a peak liquidity window at the top, and a sharp and abrupt risk off decline. And what's interesting is so much of the exit value and liquidity value in venture capital is essentially captured in these very short, tight periods of excess. And so we actually came out with some analysis last year, and we looked at the past decade of exit value in both US and Canadian venture capital. And if you look at the past decade of exit value, what we found was over 50% of all exit value from US and Canadian venture capital over the past decade came in just 2020 and 2021 alone, which is pretty remarkable. 2 years were responsible for 50% of the entire exit value. And so I think broadly speaking, I don't necessarily think this year or next year or the year after will probably be major years for liquidity. I think we'll start to see some green shoots, and we'll start to see some names go public and some names hopefully get some acquisitions, and the tender offers and secondary market will continue to be as active as it is today. But I think the important piece for folks who are investing in venture capital is to understand that this is just a long-term patient asset class, and the importance of being able to invest now in a down market, given the fact that these periods of excess typically happens once a decade. If it takes 8 to 10 years for a company to ultimately go from being founded or at least getting their first initial footing to ultimately exiting, If you look at 2021, that was a crazy year for liquidity, but which vintage years benefited the most from that year? It was vintage years 2010, 29, 2011. And what was happening at that time? Folks were coming out of the global financial crisis. It was very difficult. It was very uncomfortable to be investing in a very illiquid asset class and very risky asset class like venture capital. But in hindsight, I would have said at the beginning, the only vintage year that produced a top quartile DPI across 3X was 2010. So they were the folks that benefited the most from that 2021 exuberance. And so that's why I think now, from a liquidity perspective, these very short periods of peak liquidity are where so much of the exit value is generated. I think those typically happen once a decade, as we've seen from the time between the dot-com boom to the GFC to now kind of post-ZERP. And I think the IPO market, the M&A market, and the secondary market will ultimately play three big prominent levers for generating that liquidity when the time is ready to come.
Okay, you mentioned down market. Why do you say it's a down market? Because valuations are at the peak. If you look at data, like at all stages, almost all stages, the valuation has recovered from 2022 and 2023. So it's at the peak in literally all stages. The American investments into startups is also growing. In some areas, I mean, it's constrained. So AI is the hottest area. The only thing that probably from a down market perspective I can mention is the number of investments are not high enough. So there's a risk of environment where the VCs are investing into very selective startups, which they think right now makes sense. But otherwise, if you have some other angle to this data on why do you call it as a down market right now?
Yeah, and maybe I'm being too harsh, but the reason why I think it's a down market, to understand the health of an ecosystem, a lot of the data that gets reported on today is typically capital invested by VCs into startups, which is kind of what you just referenced, right? And you look at some of the pitch book reports and it's great data. But that doesn't tell you the complete picture as to the actual health of an ecosystem. To understand the health of an ecosystem, you have to understand capital invested, capital fundraised by GPs from LPs, and then capital exited. If you look at capital invested, and again, because I'm in Canada, a lot of my data and a lot of my mind's focused on this Canadian market, the dollars invested in rounds completed are still below 2023, actually more in line with 2018, 2019 period. So that's obviously not necessarily a down market because everything's going to be down relative to 2020 and 2021. But we haven't seen the same rebound in both capital invested and deals completed as you would see in the US market. But I'd also be curious to see how much of that capital is concentrated in very few mega deals, which are getting bids by very big funds. If you look at the fundraising side of the equation, it's very difficult for funds to raise money. It's very difficult because LPs essentially aren't getting a lot of liquidity back. They're still getting capital contributions from and capital calls from record fundraising volumes that they had in 2022. And so they're just being a little bit more mindful about making new investments in new franchises that, you can't overcapitalize venture capital as an asset class. That's one of the risks of it. And then from a liquidity perspective, like I said, we're seeing, recently we saw Chime, we saw Figma, you saw Service Titan, you saw CoreWeave. Like we're seeing some really strong names go public and actually have some really strong performance. The M&A market is starting to get there. The secondary market seems quite liquid for a very subset of names. Like obviously the power law is still very prevalent in the secondary market and that will continue. But I think from a liquidity perspective, we're still not seeing the same level of liquidity that we probably would have seen over the course of the past few years. So maybe not a down market, but from my perspective, definitely still some challenges that we're working through when you look at the capital and the ecosystem health across exited, fundraised, and invested.
I totally agree. So not everything is picture perfect, but sort of improving in directions with different strength altogether in different areas, different geographies, and so on. With that, John, thank you so much for joining in and covering the beloved topic of small versus big funds within the venture space, as well as the IPOs. I love the analysis. I think a lot of people don't pay enough attention to the power law. I mean, they use the word power law quite often within venture, but they don't understand the power law exists in public markets as well, not just with venture-backed IPOs, but also in general. So amazing analysis. Keep on shining light with your insights and with your thoughtful approach towards data. So thank you so much for joining in.
Rohit, thanks for having me. Absolute pleasure.